Welcome to the Deep Dive. Today, we are digging into the Q3 2025 earnings for Kohl's Corporation.
And this one was really important. A lot was riding on it.
It really was. We finally got confirmation on a big leadership change and maybe, just maybe, a clear path forward.
Right. Michael Bender is officially the permanent CEO. He's been interim since May and on the board for a while, since 2019, so he's not new.
But the question wasn't about him, really. It was about the strategy,
Yeah.
What direction are they actually going in now?
And I think we got some answers. The results, they were pretty solid.
Yeah, for the third consecutive quarter, they actually beat their own expectations.
Which is, that's not luck anymore. That's starting to look like real momentum.
So that's our mission for this deep dive. Figure out if this momentum is for real and what specifically is driving it under the hood.
Let's start with the top line numbers, the big picture. Net sales were down 2.8%.
Okay, so still down.
Still down. But the number to watch is comparable sales. So stores that have been open for at least a year,
right,
that decline was only 1.7%. It's a big improvement from before. It's that sequential story they want you to see.
And the bottom line?
Adjusted earnings per share came in at 10 cents for the quarter.
Okay, so that narrowing decline, where did it come from? Were people just, throwing more stuff in their carts?
That's the interesting part. No. The average amount people spent was flat compared to last year. The entire lift, and I mean all of it, came from more transactions.
So just more people, more foot traffic, more clicks.
Exactly. They're getting people in the door, which is, step one for any retailer.
And that has to connect to their Kohl's card holders, right? Their most loyal group.
It does. They made a point to say that sales from card customers improved by over 500 basis points from Q2.
Wow, that's a huge sequential jump.
It is. But let's be clear here. Sales from that group are still down.
Oh.
Yeah, down high single digits compared to last year. So an improvement, but from a very low base.
That's a really interesting point. If your most loyal customers are still spending less, but your overall traffic is up enough to almost get you to flat.
It suggests they're bringing in new people, right?
Right. Maybe younger shoppers from Sephora who aren't signing up for the card. Is that a trade-off they're willing to make?
Well, the story they're telling is that they're winning the core customer back. And that 500 basis point improvement suggests those loyal shoppers are responding to the changes.
Okay, let's talk about the flow of the quarter itself. It wasn't a straight line, was it?
Not at all. August started off really strong. Back to school season.
As you'd expect.
But then September kind of fell off a cliff. The weather was just too warm.
Nobody's buying sweaters and jackets in 80-degree weather.
Exactly. It killed their fall seasonal business. But then October was the star.
What happened in October?
They delivered a positive 1% comparable sales number.
Positive 1%. That's the proof point, isn't it? If you're building the bull case, that's the number you circle.
That's it. It shows the strategy can work, even in a tough environment.
Okay, so let's shift from sales to the financial health of the company, because momentum is great, but you need a solid foundation.
And their efficiency story is, frankly, pretty compelling. Gross margin in Q3 was 39.6%.
That's pretty good in this environment.
It's an improvement of 51 basis points from last year.
Okay.
And it came from two places. One, just better inventory management.
Buying smarter.
And two, a better product mix. They sold more of their own proprietary brands, which carry a higher margin.
So that focus on their in-house brands isn't just about the product, it's a direct profit driver.
A huge one. And at the same time, they were cutting costs pretty aggressively. SG&A was down 2.1%.
SG&A, remind us.
Selling, general, and admin. Basically, the costs to keep the lights on: stores, marketing, shipping.
And management's saying this isn't a one-time thing.
Right. They use the word instilled. They're saying this cost discipline is now part of the company culture. It's structural.
Got it. But they did have one weak spot. This other revenue line was down 17%. What's in there?
That's mostly the credit business. It fell to $168 million.
That sounds bad.
It does, but it was totally expected. They were comparing against the huge launch of their co-branded credit card last year. So it was an impossible comparison. It's more of an accounting thing than a real operational problem.
Okay, that makes sense. Let's talk about the balance sheet then, specifically debt.
This is where the story gets really good. First, inventory is down about 5%. Cleaner stores, fewer markdowns.
Always a good sign.
But the headline is the debt reduction. They've been paying down their revolver, their short-term credit line.
By how much?
They cut borrowings by over $700 million year over year. It's down to just $45 million. And they plan to have it fully paid off by the end of the year.
That's That's massive. Paying down that kind of high-interest debt shows real confidence in their cash flow.
And they should be confident. They're on track for $1.3 billion in operating cash flow and $900 million in free cash flow this year.
Wow. And what about spending? CapEx.
$400 million this year, mostly to finish the Sephora store-in-store rollouts. Going forward, it should settle into a more normal 350 to 400 million a year.
Okay, so the financial house is getting in order. Let's get back to the actual strategy. How are they navigating this tricky consumer environment?
They're pretty candid about it. They said, low to middle income and younger customers are feeling the pressure. They're being very, very picky about where they spend their money.
So what's the answer?
The answer is to stop trying to be everything to everyone. They're shifting focus back to that core, loyal customer. They even admitted they'd sort of neglected that group while chasing new shoppers.
And that's where the proprietary brands come in. You said they saw positive growth.
They did. In women's, it was the old standbys Lauren Conrad, Simply Vera Wang.
Simply Vera is still going strong.
It is 9 lives. And in men's, the big winners were Flex and Tech Gear.
And Flex is interesting. They're not just keeping it in the men's department.
No, they're expanding it. They just launched Flex for Kids in 300 stores, and they're rolling it out to more next spring. It's a platform brand for them now.
Smart. Take what works and spread it around.
And they're changing the stores to feature these winners. They moved the entire juniors department to the front of the store.
Where'd they put it?
Right across from Sephora.
Ah, genius. Catch that cross-shopping traffic immediately.
And it worked. Juniors ran a positive comp. Even the home category, which has been tough for everyone, saw a huge improvement for them.
But the real driver, the engine, is still those growth accelerators.
Absolutely. That's accessories, jewelry, impulse, and of course, Sephora. Altogether, that group delivered positive comps.
And Sephora is just a monster.
It's on track to be a $2 billion business for them in 4 years.
$2 billion inside Kohl stores. That's just wild.
And they're keeping it fresh. They announced that Emmy Cosmetics are coming to 850 of the Sephora at Kohl's locations by spring 2026.
Emmy is a huge get, another reason for people to come in.
And while they're there, they're getting them with these impulse queuing lines.
The little displays by the checkout.
Yep. They put them in 613 stores. Sales from those displays were up over 40% in the quarter. It's just adding one more high-margin item to the basket.
So let's talk about value. You mentioned they were re-engaging the core customer. A big part of that was fixing the coupons, wasn't it?
It was a huge point of friction. I mean, you'd have these cool new brands, but your 20% off coupon wouldn't work on them.
So frustrating.
Totally, especially online. So they just fixed it. They added a second wave of about 50 of those brands to the coupon eligible list in August.
So they're just making it easier to save money.
They're making it easier to shop, period. Removing that mental hurdle. And this is where AI comes in. Beyond just marketing.
How so?
They're using it to fix their inventory allocation. They have this new mantra, trip assurance.
Trip assurance? What does that actually mean?
It means they're admitting they made a mistake. For years, they chased novelty. They added more and more styles, what they call choice count.
So lots of options.
Tons of options, but no depth. So you'd go in for a basic pair of black pants in your size, and they'd be sold out. But they'd have 100 other weird styles nobody wanted.
The trip was a bust. No assurance.
Exactly. So now they're using AI to cut the unproductive styles and invest that money into having more depth in the core items and sizes that people actually buy.
That makes so much sense. Okay, let's put on our investor hats. How did all of this translate into their guidance for the rest of the year?
They tightened up their outlook. I think it shows they have more confidence, but they're still being cautious about the consumer.
What are the numbers?
They're now projecting a net sales decline of 3.5% to 4% and comps down 2.5% to 3%. And adjusted EPS between $1.25 and $1.45.
So the goal is still to get back to positive growth. That positive 1% in October is their North Star.
It is. For the holidays, they're expecting a bloodbath, promotion-wise.
As always.
But they feel they're well-positioned with better inventory and more purchasing power for their customers now that the coupons are fixed.
What are they pushing for gifts?
The obvious stuff, Sephora gift sets, but also exclusive products, stuff from Bobby Flay's cookware line and key toys. They specifically called out Barbie, Lego, and Pokemon cards.
So hitting all the big trends. But what about margins? Can they keep them high with all those promotions?
They said margin expansion will be softer in Q4 than it was in Q3.
Why?
2 reasons. 1, more online sales during the holidays, which means higher shipping costs. And two, they're just choosing to be aggressive on price to win that value-seeking customer.
So prioritizing market share over the margin rate for the short term.
That's the plan. Get them in the door now, and the long-term structural benefits will handle the margins later.
All right, that brings us to our not financial advice segment where we dream up an outrageous, but maybe plausible trade idea.
Okay, so you look at what they've done. They've cleaned up the balance sheet in a major way. That commitment to exiting the revolver is huge. And you have the Sephora business.
This $2 billion rocket ship inside the store.
Right. So the trade idea is a long position. The thesis is that the market is just completely missing the value of these partnerships and their private brands.
So you're betting the sum of the parts is worth way more than the current stock price.
Way more. The market sees a struggling retailer, but it's not pricing in a high-growth beauty business attached to it or the improving margins from their own brands.
So it's a bet on the rebirth of retail real estate.
That's a great way to put it. They're turning these big boxes into destinations. You come for Sephora, you walk past the impulse pad, you see the new ginger section. They're monetizing that traffic.
And at the same time, the core business is generating real cash from brands like Flex and Lauren Conrad.
The conviction is that these internal improvements, the inventory, the store layout, the balance sheet, they're de-risking the business faster than the market realizes.
A classic play on operational execution beating macro fears.
That's the pitch.
And as we always say, that is not financial advice. So to wrap up this deep dive, Q3 showed real, tangible momentum. It's coming from more traffic and winning back their core customer.
And it's driven by smart, focused initiatives. Better proprietary brands, serious cost discipline, and maybe most importantly, making it easier for their customers to get value by fixing the coupons.
The whole story is about editing, getting rid of what doesn't work to invest more in what does. Less choice, more depth.
And that brings us to our final provocative thought for you to chew on. The focus on rearranging the store-moving juniors across from Sephora, creating those accessory zones, it shows this obsessive focus on optimizing every single square foot.
So the question is, how much more high-margin revenue can they actually unlock? Not from building anything new, but just by strategically rearranging the assets they already have, which are now getting all this traffic from Sephora.
It's a fascinating question. Thanks for joining us for this deep dive.
We'll catch you on the next one.